Welcome to Invest Well, Be Well, a podcast for wiser investing and stronger living. I'm Rusty Vanneman, longtime investment professional, and I'm joined each week by my co-host, Roame Murray.
Thanks, Rusty. I'm a storyteller and journalist, and I am so excited to explore the ideas, insights, and people shaping the intersection of performance and purpose.
This podcast is for thoughtful investors and driven professionals who want to grow in their portfolios and in their personal lives.
We'll talk long-term investing, behavioral finance, personal development, and what it takes to live and work with intention.
So let's get started. Let's invest well and be well together.
This podcast is brought to you by Maine Management LLC. Since 2002, Maine has been recognized as an ETF strategist that combines an institutional process with the personalized service of a boutique firm.
Invest Well, Be Well is also sponsored by State Street Investment Management. Founded as a pioneer in ETFs, State Street Investment Management, through its SPDR brand, brought the first U.S. ETF to market with a SPDR S&P 500 ETF Trust, commonly known by its ticker symbol, SPY.
Our guest today is Chip Roame. He's the founder and managing partner of Tiburon Strategic Advisors, and we had a pretty cool interview. What'd you think, Rusty?
Oh, well, without a doubt. So again, we're joined today by someone who's not only one of the most respected voices in our industry, but he's also one of my favorite hiking partners and a good friend. So Chip Roame, as you mentioned, he is the founder and managing partner of Tiburon Strategic Advisors, and without question, he is one of the leading thinkers in the asset management, wealth management, and fintech space. For more than 2 decades, Chip at Tiburon has been tracking, analyzing, and forecasting the key trends shaping the financial services industry, which has helped executives, advisors, and investors see where the puck is going. I've known Chip professionally for nearly 20 years, and personally the last 10 through our excellent adventure hikes, which again is a series of beautiful and sometimes dangerous treks across America, which is organized by Chip and also prior podcast guest Skip Schweiss. Chip is also a world traveler, a lifelong learner, and someone who truly embodies the idea of living well and leading well. And today, we talk about the big themes from Chip's recent Tiburon CEO Summit, what's evolving across clients, products, technology, and of course, in the second half, we talk about how Chip maintains his energy, clarity, and curiosity through it all. I have a lot of takeaways. What were some of yours?
Well, I had some technical issues this podcast, so I didn't get to hear some of what he said, which is unfortunate. But I thought, we talked about the generational wealth transfer, which is something that you hear about a lot. We talk about it a lot. But he really broke that down and said, this is really not a linear process. There's a lot of other things that are happening. There's spouse-to-spouse transfer that's happening first. He talked about how we're already seeing a liquidation of assets as baby boomers retire. So that's kind of the first thing that we're seeing. So I just appreciated that breakdown of, something that we all take for granted in the conversation, but here's some more detail about what's really happening.
Yeah. Well, I think my big takeaways, well, first of all, we really got to talk about his keynote presentation at the Tiburon Summit. And this is really kind of the keynote in the industry talking about what's going on. It's loaded with information, but what's really cool about this is that Chip has a take on all of this. And a lot of this is not the consensus view. He really breaks it down and really talks about where he thinks it's going. It's somewhat of a contrarian view in many cases, though quite frankly, it's not really contrarian if he's using the data to back it up. Bottom line, he's doing the work and it shows. And it was also fun in the part that your internet went out, talking about he maintains his energy. He has an 8-month-old baby and how he does all the stuff that he does. And he talks about some of the things that maintains his energy, and he has some good wisdom on that too.
Yeah, awesome. Well, let's take a listen.
Chip, welcome to the show. Welcome to Invest Well, Be Well.
Thanks for having me, Robin.
Chip, it's been a long time since you've been on one of our podcasts. Welcome back. And as you might recall, the way we get our interview started is we need a walk-up song. What's going to set the tone for today's interview?
That's a funny one, Rusty. I think you know this. I have an 8-month baby at home. So most of our Sonos system right now is baby stations, not what you're looking for. but I'm going to go with Itsy Bitsy Spider as my favorite song.
That is awesome. We have never had Itsy Bitsy Spider as a walk-up song, and that's great.
It really pumps me up. It gets me pretty excited for the day. Yep. The whole, sun coming up, rain coming down, the whole story.
Oh, yeah. I love it.
Familiar. Yeah. All right. Well, let's talk about your latest research, which you discussed in your Tiburon Summit keynote address. So you discussed how the traditional narrative of the great wealth transfer is overstated and how there's an underappreciated horizontal wealth transfer happening, especially spouse to spouse. Could you unpack that insight for our listeners, and what does it mean for advisors in practice?
Yep. Great question, Robin. I would actually say there's really three things that are worth unpacking there. So the headline, the story, the article you read over and over is, $100 trillion is going to transfer primarily from baby boomers, primarily to millennials. That's kind of the headline. And you read that story over and over, and everyone's excited. And I run to my mailbox every day hoping there'll be a wealth transfer in my mailbox. It never quite happens that way. But, I get it. I understand the story. But there's really three things that offset that you have to think about. The first, you didn't mention, but the first is we would call it the liquidation. So remember, as boomers have aged, they've gone into retirement. A lot of boomers are already retired, right? And when you retire, you liquidate your non-financial assets. So you might have a house, or you might own a small business, or you might have a 401k plan, and you roll over that 401k plan and you sell that business, and maybe you downsize that house. All of those things I just referred to, we call the liquidation. That happens when you retire, not when you die, right? The wealth transfer is about when you die. So I think listeners should appreciate right now, today, going on is baby boomers liquidation. Downsizing houses and rolling over 401k plans. And companies like Fidelity are masters at the liquidation, capturing that 401k rollover, right? So I think as people are all focused on the wealth transfer, right now, though, is the liquidation going on. So that's kind of point one. Point two is what you said, which is we call it the generational wealth transfer, but almost 48%, call it 50%, half of it doesn't go to the next generation. It goes to the same generation. It's often an older husband to a younger wife. Now, maybe it's the other way around in some cases, but it's from one spouse to the other spouse. So the money is moving to the other spouse, and then ultimately it's moving to the children. But there's a way station there, and that other spouse has to be served first. So before you get all excited about building, offsites for millennial children and helping them learn how to invest, make sure you're talking to the spouse who's going to get the money long before the children get it. That's point two. And then point three is life expectancies in America are getting longer again. We're coming out of the COVID depression in life expectancies. People are living longer. And one bad thing that does happen when you live longer is you spend a lot of money in healthcare at the end. So before we conclude that baby boomers have $100 trillion and therefore it's all going to transfer, let's just be sure we think about how long they're going to live in retirement, how they're going to spend that money on healthcare and other things. So long-winded answer to your question, Robin, but I would say the generational wealth transfer is the headline. Yes, it's $100 trillion, but don't forget about the liquidation. Don't forget about the spouse-to-spouse horizontal transfers, and don't forget about healthcare expenses at the end that will get the money will go to the insurance company, not to the kids.
Those are great points. Nonetheless, we still want to talk wealth transfer here. So in your presentation, you also highlighted the growing importance of new segments of the population. We're talking Gen Xers, millennials, and women-led households. And you also talk about the geographic migration to low-tax states like Texas and Florida. So how should wealth managers rethink their client strategies to serve this next generation effectively?
Great question, Rusty. I think there's probably four uniquely emerging segments right now that are worth paying attention to. One is the generational segments. You referred to that, right? So as the silent generation passes away, as the boomers go into retirement, the money is going to the Gen Xers, the millennials, and the Gen Zers, right? So yes, one's generational segments. The second is women-led households. So in about half of households in America today, the woman is either the primary breadwinner or an equal breadwinner. So that's a big deal, right? That's very, very different than the Leave It to Beaver vision you have of America in the 1950s. So women are about drive about half of breadwinnings in America. They're also going to get about 70% of inheritances. So keep that in mind. So the women's segment separately becomes very important. Number three, the mass affluent segment becomes more important. So people with a few $100,000 or a few $1,000,000, not $100 million, not even $10 million, but maybe 300,000 to 3 million or some number like that is a very fast growing segment. And then number 4 is the geographical migration you did refer to. The data is the data. Places like Texas and Florida are picking up millions of people, some with very high incomes, and so that wealth is shifting to the Sun Belt right now. So 4 different consumer changes, segmentation changes going on right now.
Yeah, gotcha. All right, so a lot of people listening to this podcast are financial advisors. Of course, a lot of people listen to this podcast, but a lot of them are independent advisors. And you noted in your presentation the continued dominance of the big 4. That's Fidelity, Morgan Stanley, JP Morgan, and Schwab. And you also note the rise of hybrids like robo-advisors and episodic advice models. How do you see independent advisors competing in this landscape?
Oh, great question. So I think the data is important to just make sure everyone sees. So it shouldn't necessarily drive what you do, but I think there's a lot of bad data in the wealth management industry. So in dollars and cents, the full-service brokerage firms gather the most new dollars every single year. I don't remember the last year that wasn't true. So remember, full-service brokerage firms include the 4 wirehouses, Merrill Lynch, Morgan Stanley, Wells, and UBS, but also the Ed Jones, the Ameriprise, the Janney Montgomery Scotts, the D.A. Davidsons, all these firms, right? That group of full-service brokerage firms gathers the most money. The discount brokerage firms, the Schwab's, Fidelities, on their retail side, not their custody side, on their retail side, gathers the second most money. And the independent advisor is actually in third place. And they're almost always in third place every year in dollars. Make sure you hear me saying in dollars. In percentage terms, the independent advisor channel is much younger and much smaller. Therefore, in percentage growth rate, it's much higher, right? And everyone quotes the percentage growth rate. And somehow that leads you to say that the wirehouses or the full-service brokerage firms are dying. They're not dying. They're gathering more money than the independent advisors. It's just, that's really, really bad math is what that is. So that's just kind of the basic facts. Now, the numbers roughly, Rusty, are about $900 billion into full-service brokers, about $600 billion into discount brokers, and about $400 billion into independent advisors. So that's still $400 billion flowing into the independent advisor channel. So I'm not trying to be depressed about that. I'm just trying to keep them in order in my head, right? So how do you compete? A couple of ways. One thing that RIA and the independent advisor industry is doing already today is the aggregation trend. This is a big stinking deal, right? So when you become a $100 billion RIA, a $500 billion RIA, Tiburon will tell you you're going to have $1 trillion RIAs here fairly soon. So I'm talking about the firms like Cap Trust and Mercer and Mariner and Wealth Enhancement Group and Allworth and, Edelman Financial Engines and Fisher and Focus and all these firms, right? All of these firms are becoming dominant. And what that allows them to do, Rusty, is pour the marketing money in, right? So once you become that big, now you can start driving organic lead gen. And that's a big opportunity for the large firms. Doesn't mean you have to be at a large firm. Don't get me wrong. Does not mean you have to be at a large firm. Matter of fact, here's a fun fact for you. Do you know that the independent advisor industry is actually fragmenting? It's not consolidating. So everyone says it's consolidating. That's the headline. It's just not true. There's a net new more independent advisors every single year, right? So yes, we had, I think the number last year is 860. 860 independent advisors did merge last year. That's a true fact. We had 1,100 new RIAs register last year. It's a net positive 300, not a net negative. It's a net positive. So the industry is still fragmenting. There's still plenty of room for small advisors. But your question was, how do they compete? Well, one big way they compete is they get bigger and compete with the big firms the same way the big firms compete.
Mm-hmm.
So some of those mergers that are happening that you've talked about are financial firms that are merging that are like broker-dealers and advisors serving multi-office advisors. So they're serving multiple high net worth families. And also you've written about how companies that run 401k plans could soon become major players in wealth management. So can you talk about how those two trends might affect everyday investors and financial advisors?
Yep. Great question, Robin. So I think let's just stick with the independent advisor channel now. Really, what's happening really is threefold. Number one is they're merging with each other, right? So you wake up almost every single day, you pick up whatever newsletter you follow, and you'll see some RIA bought some other RIA. Again, last year, the year 2024, there were 860 transactions. Remember, there's only about 200 business days in a year. That means there's 4 or 5 transactions every day now in the independent advisor industry, right? That's a lot of activity. So one thing they're doing, they're buying each other. The second thing they're doing, if you've noticed at the high end, they're buying the OCIO firms. So outsourced chief investment officer firms, right? So they can pick up hundreds of billions of dollars of, now I'm going to pick my word carefully, assets under advisement. It's really not assets under management per se, but it's assets under advisement. Makes them much larger firms, brings in-house investment capabilities under the tent. And then the third thing they're doing is buying unique other assets to diversify their offering. The most popular one now is firms are buying tax professionals or merging with tax professionals so that they can cross-sell clients there. So I'd say what's going on in the big picture, what's going on in the independent advisor industry is consolidation, but both homogeneous where they're buying each other, but also heterogeneous where they're buying the OCIO firms, the tax prep firms, things like that. On the horizon, Robin, we would suggest we jokingly call it the consolidation of the consolidators. So it's coming. It's coming to a station near you soon here. You're going to wake up someday and Mercer will have bought Mariner, or Mariner will have bought Cap Trust, or Cap Trust will have bought WEG, or something like that. You're going to see the big firms start merging with each other at some point. And again, if you know history, that's how the wirehouses became the wirehouses. So remember, what is Wells Fargo Advisors today? It's AG Edwards, it's Wachovia, it's Pru Securities. These firms all merged together to become the wirehouses. So nothing all that unique about predicting the consolidation of the consolidators, but you haven't really seen it get started yet. So I think that's going to happen. And then one last thought, you brought up the record keepers. To me, they're a complete wild card worth paying attention to. So Fidelity is the biggest record keeper. This means record keepers for defined contribution plans, primarily 401k plans, but broadly DC plans, right? Fidelity is the largest, about $3.5 trillion. Empower is number 2, and on down that list it goes. And Fidelity's been a master for 30 years at capturing the rollovers out of those 401k plans. More recently, Empower went and bought Personal Capital as their strategy to try to capture those rollovers. And we at Tiperon are very interested in what the rest of the record keepers will do. How will they try to capture those rollovers? Because they have millions of clients inside 401k plans. If they can capture 10, 20, 30% of those, they can become very large wealth managers. So that's a bit of a side note, little outside the narrow scope of the independent advisor channel, but super interesting to pay attention to because they have millions of plan participants already.
Yeah. All right, let's move from the industry to the product shelf and how it's getting reshaped. So you referred to inexpensive beta to profit-making alpha, and that includes ETFs, direct indexing, and private markets. So what innovations excite you most, and which do you think are overhyped?
Most of them are overhyped, Rusty. I think product purveyors get paid for hyping, and therefore there's a lot of hype on products, right? So, again, I'm a data guy. The basic facts are ETFs have flows of over $1 trillion a year. $1 trillion a year, right? And you compare that to literally anything else. So direct or personalized indexing, everyone's all excited about it, right? Its flows are about 70 billion. So it's 7% of ETFs flows. 7%, right? So is that interesting? Is that an interesting trend? Yes, it's an interesting trend. Is it anywhere close to the ETF trend? No, it's nowhere close to the ETF trend. So I'd say the things that are most exciting on the inexpensive beta story, ETFs is by far the most interesting thing there. Even lower cost CITs, collective investment trusts, which are used in 401k plans, that's a pretty interesting story as well. Much, much, much smaller. Things like direct indexing are small. Active ETFs, let's come back and talk about active ETFs for a second. ESG is kind of a dog in the U.S. It's very popular outside of the U.S., sustainable investing or ESG, a little bit and not getting any flows in the U.S. Okay, let me go back to active ETFs. So this is an interesting one to pay attention to because last year flows into active ETFs are about 300 billion, 290 billion last year. But there's 2 big warning signs. Be careful for 2 things. One is some of that's conversions of mutual funds, right? So that's not really a net new flow. That's not a customer came in and gave you money. That's you took money that was in a open-end mutual fund and moved it to an ETF. That's not really a new dollar to capture. And secondly, a couple of the big players in active ETFs are quasi-indexers. So I think of firms like Dimensional or Advantis and that. You could argue they're indexers, you could argue they're active, whatever you want to argue, I don't really care. but some of the flows is going to them. So the flows into active ETFs aren't quite as big as everyone's saying they are. So I'm not trying to be a naysayer. I'm just trying to be a realist about that. So what excites me on the long only side is ETF flows. These other things all feel like they're much smaller. That's kind of that side. On the other side, on the alpha side, it's well, first of all, everyone says it's alternatives. It's not really broadly alternatives. It's really private markets. And then frankly, even within private markets, it's not private markets. It's private credit is what's getting all the flows right now. So we're talking about debt instruments. We're talking about credit instruments. I'm not betting on venture capital or growth equity or private equity. I'm betting on private credit. That's where the flows are going today. So as a money managers love that business. You got these fees on the ETFs that are 3 and 5 basis points. And over here, you're charging 150 or 2 and 20 or some crazy number. So, it's very, very different revenue generating businesses. So money's flowing to the ETFs and money's flowing to the private credit. Those are kind of the facts. The rest of it's, I think, a little hype.
This episode of Invest Well, Be Well is brought to you by Main Management LLC, a pioneer in actively managed ETFs since 2002. Main Management starts with a clear fiduciary focus, delivering the transparency and personal attention you'd expect from a boutique firm. They provide financial advisors with solutions, not products. Main also believes investors should keep more of what they earn, emphasizing net of fee after-tax performance to help clients retain more of their returns. I've known Main Management for years. I've met thousands of managers over the course of my career, and one quality I really value: they invest alongside their clients. They eat their own cooking. Over 10% of the assets they manage are their own partner assets, and more than half of the firm are partners themselves. That says a lot. To learn more about Main's strategies, including buy right hedged equity, U.S. sector rotation, thematic innovation, and all asset models, please visit their website at mainmgt.com. So you did also mention something called next-gen investments in your presentation, and that's from tokenization to meme coins and even sports betting. Are these just fringe curiosities, or is it signals as something broader in terms of investing?
I think it's a great question. I think your listeners, Rusty, could have different answers to this one. So I'll make you the list. So it's crypto and it's meme coins. I mean, give you an example. Bitcoin's one thing. Some of these meme coins are crazy, but meme coins have about $75 billion of market cap now. Meme coins, right? They're worth nothing, and they're worth and they're valued at $75 billion, right? Even meme stocks could be in this category. Tokenization's clearly in this category. You brought up sports betting. Even prediction markets are in this, category, right? Okay, so is that stuff investing? Is that stuff relevant? Well, I don't know, because how I think about it, and I think you can have different opinions on this, is if that's how the Gen Zers want to invest in their terms, right? Maybe you have to serve them where they are today, and over time convince them to invest in some, I'll say, more logical way or some more sustainable way over the long haul. You could say, oh, no, I'm never going to participate in that stuff. I'm not going to do that. But I'm not sure that stops those people from putting their money there, right? So they're going to just go put their money with someone else who does that stuff, right? So, and I told a story the other day. I worked at Schwab 30 years ago, right? So I was a strategy guy 30 years ago. This is before most of you were born, kind of thing, yeah? And this is when there is no internet. I remember when we invent touch-tone trading on a telephone, just so you're clear, right? But back then there was a branch called 101 Montgomery, which is the core Schwab branch. And these old men used to sit in the Schwab branch and watch the ticker go across. You couldn't do it on your computer. So they sat in the branch and watched the ticker go across, and they would literally buy stocks based on that, right? They're like, oh my God, something is up $5. I'm going to buy it, kind of thing, right? I mean, how is that different than prediction market? That guy didn't know anything about that stock, literally nothing about that stock, right? So I don't know, maybe this is how people do things. And I want to see everyone save and invest and have a secure future and all the right things. But if you won't do what they want you to do, they probably don't talk to you is what happens. And they go talk to someone else and they do more of that thing anyway. So I don't know. I'm kind of balanced about this. I don't think it's the greatest place to put their money, but maybe that's what they're going to do anyway. So maybe you want to help them. Yeah,
that makes sense.
So you've also talked about how marketing and organic growth are really top of mind for every firm, and that even finfluencers now matter. What best practices do you see that separates firms that grow from those that stall?
Good question. So I do believe that, the premise of your question, Robin, I believe lead gen is the wealth management channel's number one issue, right? You could say it's technology platforms. You could say it's broadening their product offerings. You could say it's succession planning. I think lead gen is the number one issue for most wealth management firms, right? And there's really four things going on. You have the traditional ways of getting referrals, whether your client gives you a referral, or you meet up with the local CPA firm and they give you a referral, or you get in the Schwab program and you get referrals, or you buy leads from a firm like Smart Asset and you get referrals, right? So there's the referral market. Number two, there's digital marketing. Go create your own leads, right? And that includes everything from digital advertising to writing articles to doing webinars to influencers, like you said, right? Like guys like Josh Brown, super successful, super successful driving leads, right? Number three, you have workplace marketing, so you participate in somehow in the 401k plan or the stock option plan because you want the money coming out of it is what you want, right? So I think I said four, but those are three big, fundamentally different marketing strategies out there if you want lead flow right now. Can an advisor, a small firm, really participate in the workplace? That's a pretty tough road to hoe, right? That could be a tough one, right? So then you're stuck with a referral market. If you saw last week's news was Schwab raising the minimum on their referral program from $500,000 to $2 million. Actually, I think for Schwab, that's a super savvy strategy. I think people with that amount of money can be served well by Schwab Retail, and it's a good move. For advisors, that's a bummer. That takes away about half of the lead flow to them. So they need referrals from somewhere else. I think the firms like Smart Asset, Data Line, Zoe, all those firms that drive leads to advisors will do really, really well. And I think the savviest advisors, coming back to narrow your question, Robin, the savviest advisors will self-generate leads. However they do it, it'll be digital, right? It'll be somehow digital. And I think influencers have a lot more impact than do most people today. So I think it's a big part of the future.
So I also want to ask you about AI, which is now driving personalization and productivity, as we know. How far do you think we are from genuine, scalable, human plus machine advice?
I think AI is being spoken about as if it never existed or was never here, right? So machine plus human advice is here. It's been here for a decade, right? You call in for your credit card and you talk to a machine for American Express. You call the Schwab, you end up, you talk to a machine there, right? Ultimately, you get to a person if you answer enough questions, or if you hit that damn receptionist button enough damn times, they'll finally put you through to a human being, right? But, we kind of are there, I think, in the sense of if the definition of in the future is human plus machine, I think we're there. I think the two ultimate goals of AI, either personalization, where every client feels like a segment of one, and or productivity for advisors, I think we have a long way to go. I think, most of the AI apps today that people get excited about are note-taking or something like that. Pretty fundamentally simple apps today. I think we have a long way to go, but I think it's been here a while. I think, I'm excited about the future. I think it's a long road to hoe right now. So I don't think there's a new fancy app around the corner. I'll call this guy out because I think he's aggressive, and I think it's cool that he is aggressive. The guy who runs the firm Range, who said, he's quoted the other day saying, all advisors will be out of business. AI will replace advisors. I fundamentally disagree. I mean, I commend him for having the guts to have that view and to say that view, but I fundamentally disagree. I don't think we're moving to AI serving clients standalone. I think we're moving to far more efficient advisors with a lot of things being done by AI. So I'll give you a practical example. I sit on 10 or 12 companies' boards of directors, one of which is Facet Wealth. And Facet's a master at leveraging, I would say, even technology, let alone AI, right? The average Facet advisor serves 400 clients and does it very, very efficiently because almost everything you can get done by technology, the firm gets done by technology. So advisors spend all their time meeting with clients. I mean, isn't that really the ultimate goal? Isn't that what we all want? So, I think that's where we're headed. I think we're still a ways to get there.
Chip, I want to go back to something you touched upon earlier. And across investment management, wealth tech, and advice, you see venture capital, M&A, and IPOs accelerating. In short, what does that mean for advisors choosing partners or platforms?
I'll answer your question. Before I do, let me make sure, say what I believe. I believe M&A across all three will accelerate. So in investment management firms, so think BlackRock or Franklin Templeton, there'll be lots of M&A in that world. In wealth tech, so think Envestnet or Orion, there'll be lots of M&A in that world. And in wealth management, think RIAs, there'll be a lot of M&A there. I don't believe there'll be a lot of venture in anything other than tech. So in wealth tech is where the venture will flow. And I don't think we have a big IPO flood coming. I think there's too much private equity right now that loves these guys. Okay, so really, Rusty, the question I'll answer, my view is you're going to see a lot more M&A going forward, right? So as an advisor, as a wealth manager, one, you could merge with someone else. That's kind of choice number one, right? Choice number two, your tech company, I bet you a quarter they're going to merge with someone in the next couple of years here, right? So you should think long and hard about your tech platform and how you've built your tech stack and all, because they're going to merge with each other going forward. And the same is true of your investment product providers, right? So you're seeing a big trend right now is the long-only investment firms buying the alternatives firms, right? So I think firms like, give an example, Franklin Templeton is about 17% private markets firm today. That's crazy. They were a long-only, back in the day, they're a long-only fixed income manager. Today, they're 17% a private markets firm. So I think you're going to see a lot of consolidation amongst investment management firms and a lot of consolidation amongst wealth tech firms. And those things should inform the choices the wealth managers make today about what products they use.
All right. I'm going to put you on the spot here. So everything we've talked about, I'm going to have you try to synthesize it. So when you look at the full picture, when we're talking client evolution to structural change, what is your headline for where the industry is heading over the next 3 to 5 years?
I would say the demographics are super favorable, right? So the wealth channel, the U.S. wealth management channel will grow dramatically in the next 3 to 5 years, but it will become way more efficient. We will deliver way more services, way more client solutions for the same price using a whole lot more technology. So my headline is, it's a much bigger business run a lot more efficiently.
Yep, cool. All right, let's switch gears to the second theme of our show, which is stronger living. And you have been an advocate for living fully, from traveling the world to hiking the country's toughest hiking trails. So how do you personally maintain your energy, decision-making clarity, and balance?
Oh, geez, Rusty. Oof. That's like...
dealing with an 8-month-old.
Yeah, give life advice. Okay, so I would say, by the way, I attribute what you attribute to me there. I have a 17-year-old boy, Will, who's phenomenal. And I attribute to him my focus on living my life. So when he was born, so 17, 18 years ago today, I really kind of did a hard look at what I was doing with my life and said, I want to be a dad. I want to be super involved, and I want to hang out with this kid and go to the park and, someday hike mountains with him and ski with him and run with him and all this stuff. And I've done it for 17, 18 years. So I have put work in the back seat of my car and put kids in the front seat of my car for 18 years now. And I love it. Okay, so how do I maintain my energy? Oh, well, one is that you don't have a baby. That's what you don't do to maintain energy. He's an energy user, But I work out every day, like lots of people. I try to get some exercise wherever I wake up. This morning, I'm in St. Louis, Missouri. I'll go give a speech today, and I'll go for a run, and then I'll fly to New York, right? So I somehow squeeze in exercise every day. Number two, I work every day. I know some people have the opposite view. I got to have my weekends off, or I got to take 2 weeks here or there. I actually don't like that. I like keeping up with my email account. If nothing else, I want my email box to be empty at the end of the night, right? So that's a big deal to me. Kind of keeps my stress level down, allows me to refer things off to other people. So I exercise, eating right, keeping my email box clean are kind of some of my solutions to life. But I definitely, I'm 17, I'll call it 20 years into, living my life to being my primary goal.
Yeah. Hey, I can confirm that anytime I text you or email you, I get a response really quick. So I can confirm that. All right, here's another question. So because you are so connected, given your role and have been for decades now, and you've spent decades studying leaders across wealth and fintech, what do you think are the habits or practices that consistently show up among the top performers in our field?
Ooh, good one as well. We at Tiburon have, for our own company, a thing we jokingly call the 10 Commandments. That's probably not a very good joke, but, about 10 ways we run the company that really matter to us, right? And it's about helping everyone be super efficient at work and things like that, right? So I think companies that are well run, like think about the best run companies, or actually here, don't think about the best run companies. Think about the companies that have the biggest net flow. So by definition, they're winning in the market, right? Those companies are Fidelity, Schwab, JP Morgan, Morgan Stanley. These firms have humongous net flows, meaning customers, clients, prospects are voting with their money and giving it to these firms. And then you step back and think about what do the leaders of those firms do, right? Firms like Fidelity is associated with the Johnson family, whether it be Ned Johnson or Abby Johnson, right? Schwab's associated with Chuck Schwab, right? Morgan Stanley was run by a guy, James Gorman, for a long time. JP Morgan's run by Jamie Dimon to this day, right? They've all had humongously strong, identifiable leaders. Think about that. And those firms are winning in the wealth management market. Clear leaders, clear cultures, clear business strategies, clear tactics. Again, I'm super impressed by all four of those firms, and they're not the same as each other, but they're equally super successful.
Yeah, very cool. All right, Chip, if you had to summarize your personal philosophy on performance, we could be talking about professional and personal, what would it be?
Give me some more juice to that one. What do you mean by philosophy about performance? What are you looking for?
Yeah, we're just talking performing at a high level. What is your philosophy on just performing at a high level? What does it take? And again, at a high level, we're talking both professional and personal.
Yep. So I think this goes back to your first question a little bit about putting the kids in the front seat and the work in the back seat. I think if you want to have a super successful life, a business life, personal life, whatever, number one, you have to have a strategy. You have to be clear where you're driving the car to, right? I think there's too many people driving the car that aren't quite sure where they're going. It's kind of like you might get there, you might not get there, but you got to know where you're going. So I'm out of business school. I'm a McKinsey consultant, right? And you kind of put strategy at the front of everything you do, right? If you don't have a damn business strategy, what the hell does it matter what your tactics are? You're just working on something. You don't know if you're working on the right thing. So I think I'm pretty anal, and I think the great leaders you asked about in the last question are pretty anal about being clear on business strategy. Where are we going? And then you can apply life strategy as well, right? What is the most important thing to you in your life or your business? Where are you trying to go? And then number two is building the tactics to get you there, right? So I think you have to have a strategy, you have to have a set of tactics, and then it's a long slog. I think people who think everyone reads about the .com guy who got rich real quick. I wish it worked that way most of the time. That is such the outlier case example, right? Most successful people, in my mind, Rusty, professionally and or personally, have got there by 2 steps forward, 1 step back, 2 steps forward, 1 step back. So I think perseverance is the third thing, right? So you got to have a strategy, you got to have the right tactics, you got to have the right team and things like that. But God forbid, you got to persevere, right? It is not going to go well. It's not going to go swimmingly right down the path you want it to. And it's in the difference between those who sit back one day and say, I made it to where I wanted to make it. I spent a lot of time with my family, or I traveled the world, or I built a business, or whatever it is. I think those are the people that persevered when it got tough.
Oh, I love it. Pure gold. Well, Chip, thanks so much for coming on the show. Before we let you go, where can listeners follow your work and continue learning from you?
So my day job is I run Tiburon Strategic Advisors and the Tiburon CEO Summits. Anyone can go on the Tiburon website and subscribe to what we call our research release. It's free. There's nothing to buy here. It comes out on Friday mornings. Rusty, it's kind of like our newsletter, if that makes sense. So Friday mornings. So our website is Tiburon, Tiburon. That means shark in Spanish. Advisors, Advisors, TiburonAdvisors.com. And just sign up for the Tiburon research releases. Those are free. Tells you the research we publish that week, et cetera, et cetera. People that want to get more involved could become a member, come to the summits, watch webinars and all that. But the releases are free. So there's probably no reason not to do that for all your listeners. So that'd be my 2 cents.
Well, awesome. And for those wondering why I hogged all the questions in the back half of the interview, Robin did drop because of an internet outage, but man, it's tough getting Chip. So we took him when we can get him. So Chip, again, thank you so much for your time. Good luck on the road. Good luck getting some sleep, and really appreciate your time and your friendship.
Thanks, Rusty. See you soon, buddy.
Awesome.
Well, my internet is back just in time to say goodbye. So we will be back next week. Thanks for listening to Invest Well, Be Well. Let us know what you think. And if you like what you hear, don't forget to subscribe. This podcast is hosted by Rusty Vanneman and Robin Murray and produced by Garrett Crosby.
If you have feedback, guest suggestions, or just want to connect, please visit my website, rustysbridge.com, or email me directly at rusty@rustysbridge.com. Until next time, invest well and be well. This episode of Invest Well, Be Well is brought to you by Bonrian Capital, led by my friend and colleague of nearly 10 years, Shana Sissel. Shana was named a top 20 wealth tech CEO in 2025, and it's no surprise. She's passionate, does the work, and knows asset managers, portfolio allocations, and alternatives like few others in the business. She's authentic, tough, and deeply cares about all her stakeholders, the kind of character you'd expect from the daughter of a police officer. If you want an investment manager who combines deep due diligence with innovative solutions and alternative investments, please check out Bonrian Capital at bonriancapital.com.